All right, let's talk about Li Auto, because what's happening with them right now is just fascinating. Their latest earnings report is a complete paradox. It tells two totally different stories at the exact same time, one of incredible strength and another of some really, really deep weakness. So let's try to unpack this puzzle.
Okay, let's jump right into the heart of the mystery. How on earth can a company post a fantastic 20.1% gross margin, and remember, this is during a brutal EV price war, while at the same time forecasting a catastrophic almost 40% drop in sales for the next quarter? I mean, those two things just don't go together. It doesn't add up.
So to solve this, we really have to look at the massive gap between the story that management was telling investors and the story the actual numbers are telling us. And trust me, this is where it gets really interesting. So first, here's the story management wants everyone to hear. On their earnings call, they painted this super rosy picture, The Li Mega is a success, the new i8 SUV is a huge hit, they're pouring tons of money into cutting-edge AI. They sounded really confident, just brushing off any issues as simple sales fluctuations. But that whole optimistic story just smashes headfirst into this chart. This is the company's own official forecast, and it predicts a massive 38 to 41% drop in deliveries compared to last year. Let's be really clear here. A 40% drop is not a fluctuation. That's a collapse.
And here's the bottom line. The rosy story and the disastrous forecast just can't both be true at the same time. It's not logical. When you see a gap this big, it suggests the real problem is way more severe than what the company's letting on.
So where do we find the biggest clue to what's really going on? Well, you follow the money. And that means we have to look at the company's cash flow. Now, before we look at the numbers, it's super important we're on the same page about one key metric, free cash flow. You can forget about reported profit for a minute. This number tells you about the actual cold hard cash moving in and out of the company. It's one of the absolute best ways to see if a business is genuinely healthy. Okay, so on paper, things look pretty good. The company reported a net profit of 1.1 billion RMB. Seems fine, right? But here's the smoking gun. During that exact same period, they actually burned through 3.8 billion RMB in cash. So you have a positive profit on one hand, but a huge negative cash flow on the other. So the billion-dollar question is, where on earth did all that money go? Well, management's official explanation is that they spent the cash to buy more inventory. But that just doesn't make any sense. Why would you aggressively stockpile parts when you just told the entire world you expect your sales to collapse by 40%? The much more likely reality is that this wasn't some strategic choice. It's a sign that unsold cars and parts are piling up because demand just fell off a cliff. So what's causing this demand collapse? Well, the pressure isn't just coming from one place. It's coming from both fierce competition on the outside and, you won't believe this, self-inflicted wounds from the inside. So on the outside, you have this massive competitor, Huawei's Ato, and they are causing huge problems. They're using all of Huawei's brand power and tech to go right after Li Auto's core customers. And just to give you an idea of how well it's working, the sales of just one of Ato's models now rivals the combined sales of Li's two main flagship SUVs. But the pressure isn't only external. Li Auto also managed to create its own internal chaos. Back in March, they launched this huge new sales reorganization. It was a complete and utter disaster. By June, sales had plunged, and by August, less than 6 months after they started, the whole strategy was scrapped. It just backfired spectacularly. And all this chaos, it didn't go unnoticed. In fact, some of the world's biggest and smartest investors, the so-called smart money, they saw the writing on the wall long before this crisis went public. And just look at the scale of this sell-off. We're talking about major global funds here. The Canada Pension Plan, they sold 100% of their stake. Gone. Marshall Wace, Fidelity, Morgan Stanley, they all dumped huge portions of their shares before all this bad news hit the market. They saw the trouble coming from a mile away, and they voted with their feet. So all of this brings us to the core debate around Li Auto today. It's a classic bull versus bear fight. Do you focus on the company's long-term strengths, or do you focus on its immediate and very severe operational crisis? The optimistic view, that's the bull case, is pretty straightforward. The company has a fortress of a balance sheet with over 100 billion RMB in cash. That's a huge cushion. Their high gross margin proves they know how to build cars profitably, and their track record shows they can create hit products. The bull argument is pretty simple. They have the money and the proven talent to fix this and ride out the storm. But then there's the skeptical view, the bear case, and it's just as compelling. It argues that burning through cash is a massive red flag you just can't ignore. Their main products are hitting a wall against fierce competition. And that disastrous sales strategy, it has shattered a lot of confidence in management's ability to execute when things get tough. So here's where we land. Light Auto has the financial strength of a fortress, but there is a fire raging inside its walls. And this leaves us with the central question. Can a company's deep pockets and long-term vision save it from a brutal short-term crisis, especially when it's a crisis the company helped create itself? That's the billion-dollar question the market is trying to answer right now.